Are you thinking about buying a home, but you don't know if this is the right time? If that's the case, this video was meant just for you. Yes, let me tell you from somebody in the industry, there are always challenges on the path towards homeownership. It seems like when you finally overcome one thing, another thing comes out of nowhere, whether it's rates, inventory, inflation, you name it. One thing I can tell you in this industry, more often than not, if people have one regret, that is that they didn't buy sooner.
Oh, this? That's my credo. No regrets.
Let's break that down. Say that you're renting a house for $3,500 a month, right? And yes, while you have a roof over your head, you're spending about $42,000 a year. Granted, your situation may be slightly different, but you can do your own math. This is just an average rent in our area for a house. Let's look at a real life scenario at a home listed here in Orange County for $789,000. Let's say you down 20%. Your principal and interest payment would be right around $3,300 in today's market. Of course, you're also responsible for taxes and insurance, bringing your total housing expenses to $4,320. I know what you're thinking, and you're right. Your monthly expenses increased by $820. But let's drill that down a little bit further. Homeownership comes with a tax benefit, which you don't get when you're renting. The interest that you pay on a mortgage is tax deductible. A tax deduction is the amount you subtract from your annual income before calculating the amount of taxes you owe. Because taxes are calculated based on a percentage of your income, a tax deduction will save you money come tax time. But I'm a licensed mortgage loan originator, not a tax professional. So why don't I get my tax professional on the line? Hi there, Hal.
How are you?
Good, how are you?
Good, Nancy. Fine.
Good. Well, I was hoping to take a minute of your time to share some insight. What would you say, some of the benefits are to home ownership?
What's the main concern for a lot of people is you get a tax deduction for the most part for mortgage interest, which has limitations for a lot of people on how much they can write off and whether or not they can deduct the interest. But that's the primary tax advantage, is getting the mortgage write-off.
How does that work for tax deductions on the mortgage interest?
Well, every individual is different, but for the most part, if you're in a common federal tax bracket, would be about 20 to 24%. California about 9%. So let's say a third of that. So whatever your mortgage interest is, subject to a lot of limitations, you can deduct the mortgage interest, and it saves you about a third of whatever you pay in mortgage interest. So if you pay $20,000 in mortgage interest, you save obviously about $6,000 in income taxes on federal and California.
And then what about, do you have to be on the mortgage to take advantage of that tax benefit, or can you also just be on title?
There was a California case, I believe, it was a tax court case many years ago, that allows a homeowner to deduct interest if they are not on the loan, as long as they assume the risks of being a homeowner, which means they have to make the payment, they have to live in the house, they have to take care of the house. So a lot of times a mother or father will get on the loan so their child can buy the house as long as they make the payment and they live in the house, and they assume they call it the burdens of ownership, the maintenance, they live there, then, and they make the payment, they can deduct the interest.
Well, Hal, thank you so much for your time and your advice and insight. We appreciate it.
You're welcome.
All right. See you next time.
Have a great day.
Thanks, Hal.
All right, take care. Bye.
Rent is on the rise in cities across the country.
So gas isn't the only thing getting more expensive. As pandemic pricing comes to a close, rents are rising nationwide. According to rent.com,
Los Angeles has been plain unaffordable since before 1979.
rent is growing faster than the money most people make to pay it.
You said it, the rent is too damn high.
Thank you, Mr. McMillan.
Here's one thing you can always count on. No matter what happens with the economy, your rent will go up. The average rent increase in our market is 10% a year, which makes sense because landlords have to stay ahead of inflation. Unlike rent, your principal and interest payment on your mortgage will never go up. As a matter of fact, after a couple of years, you should be able to refinance your mortgage and reduce your monthly payments. Let's see what that scenario would look like. Okay, so you've been in your home making payments for 2 years. So your principal balance should be lower, right about, say, $612,000. Say that by then you are able to refinance and get into a rate that is 1% lower than your original interest rate. Your new principal and interest payment would be about $2,922, which is $466 lower than the original monthly payment. Quick fun fact. If after refinancing, you've included your monthly savings of $466 every month with your new regular monthly payment, you would actually save a whooping $113,545 in interest that you would have paid off your mortgage 6 years and 11 months earlier. This is a good segue into my next point. You can actually pay off your mortgage payment entirely and be responsible for nothing but the property tax. Now, I'm not saying that it will be fast and easy, but people do achieve that goal. On the other hand, if you're renting, you'll always be paying rent. Another benefit of home ownership is that you're not only putting a roof over your head, but you're buying an asset that will increase in value. The difference between what you owe and the value of your property is called equity. Equity can be accessed, which you can then use for whichever purpose, such as home improvements, paying debts, investments, sending a kid off to college, and so on. When you're renting, you're paying for someone else's investment, as opposed to when you're buying, you're investing into your own asset. Likewise, any kind of upgrades you make for your home will benefit you and add more value to your property. If you look at the same property from my example earlier, it was last sold in 2013 for $380,000. 9 years later, it's being listed now for $789,000. That is $409,000 difference, which is more than double in value when it was last sold. Big disclaimer, every market is different and no one, and I mean no one, can predict the future value of homes. In the last couple of years, we have seen a larger than usual increase. However, looking at historical data, we can say that trends of homes usually go up in value. Not to get dark over here, but just like any other asset, your home can be passed down to your heirs. Even if you have a mortgage on it at the time of your passing, your home can still be passed down. It goes without saying, none of these benefits are true if you're renting. As small as it may be, but it's still another benefit. Even if your home is under a homeowners association, as a general rule, you'll still have more freedom with your home than if you were renting. But Nancy, everything is so expensive and I can't afford the home of my dreams. So should I just wait, right? As we already established with the example, property values go up. And as a general rule, waiting will mean that you will be able to afford even less of a house in the future. Another more recent concern is inflation. Inflation means that your money will be worth less in the future. With those two combined will mean that you will have even narrower options if you keep waiting. Buying a starter home could be the perfect stepping stone towards getting into your future dream home. Let me tell you my personal homeownership story. When I decided to look for a home, I was quickly discouraged by my options in my price range. So what did I do? I decided to wait. Am I glad I waited? No, I'm not. So years later, when I resumed my search for a home, I had a renewed attitude. I was determined to get a home, even if it wasn't the perfect one. I did find a home. I bought a condo. And long story short, after a couple of years, I was able to pull the equity out of my condo and put it towards a house. This is my own personal story, but I'm not alone here. Many others' path towards home ownership looks very similar to mine. But Nancy, interest rates are too high. Here's another example of what I said earlier. No one is really able to predict the future. But what I can tell you is rates go up and they go down. I can also tell you that based on historical data, that rates are not the highest they have ever been. They are about normal rates. I get it. In the last couple of years, we have had some of the lowest rates we've ever seen. We also heard from Hal earlier regarding some of the tax benefits of carrying a mortgage, so not all is lost. But Nancy, I'm not even sure if I qualify. The first step in finding your new home is to speak to a mortgage professional that are trained to help determine whether or not you qualify and for how much. In the case that you don't currently qualify, they should be able to provide you with a roadmap to follow. Depending on what the problem may be, whether it's credit, income, documentations, down payment funds, there might be a plan that you could possibly qualify for. What's important is that you don't give up. And if you can't qualify today, you can at least get started today.
Look up, Brock. You're in the end zone.
So when is the best time to buy a home? Well, based on our example from the scenario earlier, it would have been better if you bought that home back in 2013 for half the price. So I have to say the second best option would be today, because no matter what happens with the property prices, you can almost bet in 10 years from now, they will be higher. Just like all of our videos, we cover a lot of information. So if you have any questions, please comment below and I'll be happy to reach out. And that was your Fast Mortgage Insight. Thanks for watching. Bye.